Well, the long-awaited new series of inflation has been announced. That is the first piece of data for January. Inflation for January has been announced, and the CPI has inched up by 2.75%. Now, this is important because in the old series, the poll said that the increase would have been only 2.3%. So clearly, the weightages in the new inflation are different. By the way, food inflation has gone up by 2.13%. Our poll said that in the old series, it would have gone down by 0.08%. So instead of going down, it's gone up, and that's significant because the kind of products and the weightage given to each product is different in the new series. As well, one item called personal effects or personal, services, etc., has gone up by 19%. Now, that includes an item perhaps which reflects silver and gold jewelry, which have gone up a goodish bit in the last 1 year. And therefore, there is a huge jump year on year in personal effects. Let me get preliminary comments from our Economist guests, and then we will cut into the MOSPI press conference where more explanations are forthcoming. I'm being joined by Sakshi Gupta, the senior economist at HDFC Bank, Garima Kapoor, chief economist, Elara Capital, and Sameer Narang, chief of economics research at ICICI Bank. Gentlemen and Sameer, thank you very much for your time. Very quick replies from you all, and we will cut to the press conference. Sakshi, is this coming as a surprise? What are the key takeaways from what you have read?
Right, Latha. So not a very, very big surprise from estimates that we had. So at least it's not a shockingly high number or a shockingly low number. I think that, two things that you also spoke about. One, I think the food inflation number is definitely much higher than what we were anticipating. So perhaps some of the categories on the protein side, like milk, etc., which have a higher weight in the new series, we'll have to see whether there is an upside pressure there, which is pulling up this, YY number on food. For gold, in fact, personal care and effect, you mentioned that inflation is showing in personal care and effects is 19%, but it's much lower than what the earlier series was showing us.
Okay, fair enough. Actually, there is an item which says the top 5 items that have gone up. And in that, you have tomato, which has risen by 0.5%. And maybe its inflation weight is higher. Coconut and copra are up by about 0.08, and coconut oil is up 0.05. So it appears that, that is the weight. The inflation in these items, coconut oil is 40%. Inflation in coconut and copra is 47%, and tomatoes is 64%. And that probably explains why the food inflation is higher. Sameer, you want to add to that? Am I guessing right?
No, you're right, Latha. I think the overall number is, slightly lower than what we thought, but internals are actually very surprising, as you pointed out. We've been living in a world of food deflation and very high core inflation led by personal care and effects, within which it was gold and silver. And now suddenly this month we are living in a world where food inflation is above 2%. And core is actually far lower than it was running earlier. And if you exclude the silver jewelry and gold jewelry, as you pointed out, that number has not changed much from the earlier trajectory. So what you are seeing is that some of the exclusion-based numbers, like core excluding gold and silver, is pretty much running at the levels it was running earlier. The biggest surprise is that food suddenly has turned positive.
Oh, okay. Garima, I know I'm attacking you all at a time when perhaps that e-Sankhya, or e-Sankhi, whatever it's called, that website is not even opening. And even over there, we have to tabulate so much before we get the year-on-year comparisons. I don't know how much you've been able to do, but what are the key takeaways from what you have? Are we likely to get higher inflation readings in the months to come than we were prepared for? We were prepared for something sub 4.
Clearly, the expectation was that food will continue to surprise on the downside. While my number was positive at 0.09 on Y&Y basis in the old series, 2.11 is a clear surprise. We'll have to look at internals to understand what categories are driving this. But what is important is the implication of this number. Because going forward, we are anticipating a normalization of food prices. So what this would mean is that if the current construction of the index, along with the new weights, are driving your numbers significantly higher compared to your own index, that means we should be prepared for much higher food readings, which would then have a repercussions on the headline number as well. Although on the positive side, the core number has come down very significantly. In fact, it's a sub-4 number from whatever incremental weight and the index data that we have as of now, which is available, which on the positive side, if you exclude gold and silver, should be much lower, I would believe.
Yeah, and considering that the Reserve Bank at various times has hinted that it will not be carried away by higher food inflation and that it will concentrate more on core, the fact that core is lower than what it would have been in the old series perhaps is some kind of a handle on, not expecting much from the Reserve Bank. I'll defer that view first to Lakshmi Iyer of Bajaj Finserv, who has joined us, an old hand and a veteran of the bond markets. Lakshmi, really, we don't know much, except that the current number is 2.75. To be fair, it's lower than the poll I got for the new series, which was more guesswork. We were expecting 2.89, we've got 2.75, but it's much higher than what the old series would have thrown up, which would have been 2.3. So your comments, how will the bond market react to this number?
Yeah, hi Latha. So I think the bond markets have seen yields on a one-way upward trajectory ever since the budget numbers were announced. They were barely digesting that. I think so we've seen quite a bit of upward movement and then now some stability coming in and a little bit of rally also, both in the swaps and the bond yields. I think these numbers will be digested fairly okay by the markets. I'd say that incremental selling pressure, at least for now, seems to have abated. I must also hasten to add that, alongside these numbers, the liquidity in the banking system is comfortable, right? I mean, if you see consistently, overnight rates have been trending below the repo rate. So I think that also, if there is no negative surprise in the form of VRRR over the weekend, I think the market can sustain this momentum and some bits of short covering, etc., can get covered. So I think that is what the market mood is right now, because markets were clearly bracing for a higher number on CPI, which has not really materialized.
No, take your point, Lakshmi. Thank you very much for joining us. We are actually having 1 year to the MOSPI press conference, which is on. But my team, which is watching it, says that nothing material has been said so far. And for the information of both my Economist guests as well as the viewers, the bond market has already reacted lower. The yields on the 10-year have fallen from 6.69 to 6.67 towards the end of day. Of course, it could be liquidity, as Lakshmi pointed out, towards the end of day, people just throwing in the towel. It could also be that global yields also are slightly softer. The US yields have been softer after the retail sales, though the employment numbers were strong. There could be many reasons why the yield has fallen. We will be cutting to the press conference sooner or later. What are your expectations in terms of RBI action, Samir? Anything different after looking at the new series?
I think, Latha, core number is, unlikely to go up as we were thinking earlier, because in the earlier series, in particular, housing had a very large weight for government housing or employer-provided accommodation, which has moved to market-based rents, and still we are seeing very similar numbers over there. Even for personal services, where we thought that numbers can go up, it seems that pretty much similar as we were looking at the earlier series. So this does give a downward bias to core inflation because of the reconstruction of the series. At the same time, food can be a little bit higher. And we were thinking food would be any which ways higher, but with a lower weight. So I would say that this gives a little bit of a downward bias to the overall estimates that we had. From an RBI's perspective, I think it's more about liquidity as of now rather than thinking about anything on the policy rate front, because of the fact that wholesale deposit rates and in general interest rates have been, witnessing an upward bias. So most of it is, going to be on transmission as of now rather than thinking about any policy action.
Okay. So basically, you're not expecting any policy action right now?
No, not as of now. We have to look at the GDP numbers as well, Latha. That is on the end of Feb, right?
Of course. At the moment, the guess on the GDP is that the deflator has been so low. We have had negative inflation numbers, and therefore, one expects that... is there a guess for the GDP number, Samir?
Well, we are looking at from the old series, that number should be in addition excess of 7.5%, but based on the new series should be around 7% because HFIs have been very good.
Okay. Well, at that point, it doesn't look like an economy in need of support from the central bank. Garima, what are your expectations from the Reserve Bank, given this 2.75 and your GDP expectation?
Latha, I think RBI's recent policy made it amply clear that they are looking at transmission of the existing rates, which they have already executed so far. More so, the commentary with regards to growth was fairly positive compared to the previous policy. Also, on the horizon, we should remember we have had India-US FTA, which is going to remove or overhang growth, which was significantly prevalent for the last 2 quarters, which was one concern that going forward, you would see significantly weaker numbers, especially on the export front. Net-net, given the fact that you are entering into a zone where the high-frequency indicators probably look still durable, the growth looks fairly strong given the on-ground data. And because RBI has so far indicated that going forward, remember the number for FY27 is as low as 6.6%, which is due for revision. So I do believe that the chance for RBI to now undertake any policy action is very, very limited.
Okay, so that's the unanimous voice we are getting. Sakshi, any further observations from the data? I know you all have not had much time. As well, what are you expecting in terms of Reserve Bank action with respect to your growth and your inflation forecasts?
Right, Latha. I think in terms of RBI, I agree with the other panelists. We are not expecting the RBI to move on rates. I think focus remains on liquidity. However, I do want to make a finer point here in terms of this new series. While this data does seem to suggest that the number is not extremely high and it's not a negative shock, I think especially on the core inflation front, Sameer mentioned housing inflation, which is broadly similar to the numbers we earlier had. However, one should not assume that this does not mean that core inflation will not play an important role going forward. So if in fact you do see greater pass through on the core inflation side, right, from producers because commodity prices are going up, etc., those aspects will mean that there is greater weightage of some of these risks on the inflation headline inflation number over the coming months. So I would still argue that going into FY27, even with this new series, both on food and core, the risks are clearly on the upside.
The risks to inflation are on the upside, you're saying?
Yes.
Okay, so you're saying that an RBI action in terms of a hike should not be ruled out?
Well, I'm not extending that to a hike, but I think that we will see further, upward revisions to the inflation estimates.
Okay, yeah, fair point. But your expectation about Reserve Bank's, cutting cycle having ended, which is what Garima and Sameer are opining, would be very much that further cuts are not to be expected.
Right. I think they're going to stay on a long pause. That is what we are expecting for FY27.
Fair enough. Thank you very much. I'm not detaining you longer because we are short on detail. The table which will give us the year-on-year comparison is huge. And I mean, it'll take a very long time for us to pour through it and get item-by-item comparisons. And there is, of course, the press conference which our experts will want to attend. So thank you very much, Garima, Sakshi, Sameer and Lakshmi for joining us. The message from the data, as we know now, is that inflation is higher by 2.75%, which is lower than our poll of 2.89, but higher than what it would have been if we had followed the old series. It would have only about 2.3% is what our poll threw up. The negative surprise, if you please, is food inflation is higher at 2.13%. Our poll had thrown up, about 0.1 or minus 0.08. It was expected that food prices will be lower, but we are getting a higher number, and that's because a few items have got more weightage, and that's tomatoes and coconuts. Both of those have gone up very sharply, about 40 to 60%, those items, and that perhaps explains why we've got a food inflation number which is higher at 2.13%. as well, core inflation number, which everybody expect would have been, you know, something like 4.7, 4.8%, is actually much lower. It'll probably be sub 4% in the new index. It has to be calculated. And that's the index the Reserve Bank follows very closely. So if that is going to be sedate or, you know, modest according to the new inflation index, chances of a Reserve Bank move to cut or hike rates is not very much. It's likely that the Reserve Bank will stay pat. At least that's what the Economist opinion is. At the moment, we are short on details. We will get more as the days go by and as we pour through the year-on-year comparisons data that the MOSPI will release to us. That's it on the special edition of Indianomics. Thanks so much for watching. We'll come back with more news and updates.